Let's start with JPMorgan, shall we, Dave? What do you think of that stock at this price?
Yeah, we're definitely doing some dumpster diving today, Tyler. But first of all, you cannot look at JPMorgan from a PE perspective in my mind, given all the volatility around credit reserves, whether they're releasing them like they have for the last 2 years, or if they're really starting to build them like they started to do this past quarter. One must look at JPMorgan through the price to book lens. And if you do that, Tyler, I actually don't think the stock looks all of that appealing. At Aptus, we remain underweight banks right now. We're really expecting that credit spreads will continue to widen as earnings expectations see large haircuts across the entire market, and wider spreads can really punish bank valuations. And that's what we've seen year to date with banks being down close to 30%. So, typically economic growth and rates move together. And so banks have, either dual tailwinds, improving growth and rising rates, or dual headwinds, slowing growth and falling rates. And today, we're really seeing a divergence as rates are rising, even though PMIs, well, they're really starting to fall. And when it comes to banks relative to performance, slower growth fears, well, they're more than offsetting to the benefit of rising rates, in our opinion.
All right, so not necessarily scooping this one up. What about Verizon? Dividend yield of more than 5%, super low PE. Dave, what would you do with that?
Kelly, I think this may be the first time I've ever said this, but I really like Verizon right now. Being a value investor, I love to see companies that are trading at a discount. But more importantly, I like to see companies trading at a discount with positive EPS revisions. Owning a stock solely because it's cheap, well, Kelly, that's never really been an investment thesis that I like to play. It needs some type of catalyst. Well, Verizon has that. The company just announced that they will have their first price hike in over 2 years. So I'm expecting an EPS bump of maybe 3% this year and 5% next year. And that's going to equate to a positive EPS revision, i.e. a momentum catalyst. And as of right now, I don't think the management's guidance, well, it's accounting for that. And I think I'd leave on this note, this stock, it tends to perform really, really well during recessionary periods. I'm not calling for one, but obviously there's a lot of recession talk on the table right now. But Verizon is probably the safest telco name out there. And despite how defensive this telco industry tends to look, well, it actually tends to trade really terribly during recessions because of the amount of leverage they have on the books and the slow growth characteristics. So, you couple that with what you said, Kelly, the 5.5% sustainable and growing dividend. I like this stock. It's a rental. It's not an own forever. But at this juncture, Verizon looks pretty good.
Thank you, Larry. David, let's go to Novartis. What do you think of that one?
Yeah, I think the key theme here for Novartis here at Aptus, it's clarity. We need clarity regarding the potential spinoff or sale of their generics business. Luckily, about a month ago, we found out that, hey, there could be some private equity interest here at 10x EBITDA. But we're also going to need clarity from the management team regarding the future of their pipeline. But the overall clarity will need to be around the simplicity of what their business model could look like moving forward. We know that generic companies, well, they tend to yield a lower multiple. The sale or spinoff would simplify the story a ton, which is a valuation catalyst, something that we look for here at Aptus. But honestly, in my opinion, there's really no strategic benefit of having a generic business if you're Novartis. Yes, this company has been catching a bid because we've seen cheap European, pharma companies. Well, they've really been a positive place to hide. We know that EPS numbers, well, they're probably going to be just fine this year. But I don't view this stock as cheap at 14 times earnings. Yes, it's cheap versus its history, but Novartis, well, they've been trading at these levels because of concerns regarding their pipeline moving forward. And most importantly, that the management team, well, they need to rebuild some credibility out in the market. So for us to get constructive, we need clarity around the generic business. We need clarity around the pipeline moving forward, especially because they have a record amount of cash on their balance sheet since they sold their stake in Roche. So, yeah, could there be a short squeeze in this name? It's been a heavily shorted name for European pharma companies for quite some time, but that's not an investment thesis on its own. So, yeah, I'm staying on the sidelines here.